All right, on to our top talker today. It's all about money. If you were watching the stock market today, you probably got a little dizzy. Stocks were down big early this morning on the news that the inflation number was bigger than expected. But after all the indices were down 2%, they all closed, Betsy, near 3% in positive territory. So just a huge swing.
Wow. Well, meanwhile, inflation ticked above 8% in September. The new numbers out today show the consumer price increased 8.2% compared to last September. They're also up 0.4% from August. 3 News anchor Christi Paul joins us now. And Christi, Americans are absolutely exhausted. What are the experts saying about all of this?
They're basically saying, buckle up, Buttercup. My verbiage, not theirs, obviously. However, just at least for the next couple of months, this is what we know. I spoke with Assistant Professor of Economics, Jonathan Ernes at Case Western, and he told me that the feds have this dual mandate of trying to manage inflation and unemployment. So they're signaling that there is a continued rate hike of 0.75, maybe 0.50 in December, 0.75 in November. He said what the feds need to do is make sure that they don't spark deflation.
What the Fed's trying to balance is if they pull too hard and raise those rates too quickly, they could cause a huge decrease in demand and a much larger kind of drop in the productivity in the economy. And we don't necessarily want to create that deflation. Because if consumers start expecting deflation, then you have a lot less reason to run out to the store to buy something now if you think you can buy it next month for less.
So Professor Ernest said there are 2 things we can do to prepare for rate hikes that are coming. One is find alternatives to things that you regularly buy. For example, explore some new recipes so you can buy cheaper cuts of meat than you do normally. Secondly, put your savings plan into high gear because the job market is cooling off.
We expect the unemployment rate to tick up some as we try to rein in inflation. And that means that if you're planning now and you say, well, I have that check coming in every week or every month, however often you get paid, plan a little bit differently just to make sure you have that sort of emergency fund set aside that in case you're one of those people who, for whatever reason, end up, being laid off for a period of time, or can't find as much work or as many hours of work as you previously could during this really hot job market and economy, then you have that set aside so that you're not quite as impacted for that period of time.
Is that hikes to some capacity are dependent on us, the consumer. He said there are lags associated with rate movement. So they set the rates and then they wait for the rates to go higher and then they wait for people to adjust to what is happening in terms of what we buy and how much we purchase. So it's a really delicate balance not to move those numbers too high too soon. So we head into deflation territory.
Yeah, it's like a high wire act. It really
is.
And I'm glad I'm not in charge of setting that interest rate because if it's done wrong, it can be catastrophic.
And that's what he said is very delicate right now, is making sure that they don't go too high too fast. So we hit deflation and then people might go, oh, well, if we hit deflation, I see that this is this price right now, but in a month it'll be later. So I'm just going to wait and buy that later, which does not help.
It's not good for the economy.
It might be good for us sometimes. It feels like
it can help us long term. I was reading, so I was curious why the swing, because we were down 2 percentage points, which is a massive drop in one day. And then suddenly,
you're talking about stocks?
Today, Wall Street. And I went and worked out, and in the span of an hour and a half, I checked again, and everything was up 3%. That's a 5-point swing.
Yeah.
That's monumental. I read that there was some data deep inside that inflation report that investors found very optimistic.
Right.
It was perhaps maybe we're at the end of this inflation cycle, and that sent a rally through Wall Street.
Even though most investors are saying, look, recession in the next 6 to 9 months, but they think we're really already in it. We're already experiencing it. So it's not as though, watch out, it's coming. It's here.
Right.
And it
might be short-lived.
It might be short-lived, yes.
Yeah,
but you're absolutely right, because it was funny when I looked at, they went, like all of a sudden stocks were down 500 points, then all of a sudden they were up 800 points.
Yeah.
And it was something in that inflation report that gave them some sort of hope for some reason.
Okay.
Well, we know there's going to be a lot of spending in the next few months as the holidays are upon us.
I told him that. I said, wait a minute, if it depends on what we buy, you know that we're buying things that we wouldn't normally buy, you know, at this time of year. He said, everything is adjusted seasonally. They know that. They know it's coming.
It's built into the cake.
And it's built into, yes, it's baked in.
All right, Christi Paul, we'll see you in 22 minutes. And what's now?
Oh, you are right.
I am right. I'm on it.